The minus your age rule of thumb in personal finance is a simple math formula to help DIY investors and advisors determine the best stock to bond ratio for an investment portfolio. In a second here, I'm going to show you the formula and how I've always used it. But as I looked into the origins of this rule of thumb, I found out there's a lot of wiggle room in how you can implement it. So I'll show you a few variations. You might have heard this called the 120 rule of thumb or 130 or age in bonds rule, but I'm calling it the minus your age rule of thumb because there is no consensus number, it's a range. Like most things in personal finance, how you use this rule of thumb will vary based on your risk tolerance and your individual circumstances. The minus your age rule of thumb is pretty straightforward. Take the number 130 and you subtract your age. And that gives you the target allocation percentage you want to put towards stocks in your investment portfolio versus bonds. Now, for example, I'm 49 years old, so I take the number 130 and I subtract 49, and that gives me 81. So my target portfolio should be 81% stocks and 19% bonds. I put ideal in quotes here because, of course, this is a rule of thumb and not a law. My actual portfolio is closer to 90% stocks and 10% bonds. And that's because I'm more tolerant of stock market volatility, because I have a long-term investment horizon, and stock market fluctuations just don't bother me as much as the average person. I'm going to show you a few variations of this formula. I've used 130 here, but there's a couple other different numbers you can use depending on your risk tolerance to come up with a more appropriate stock to bond portfolio allocation for you. Now, I've always used 130, but when I first learned about this rule, it was actually 120. And in that previous example, that would add another 10% to stocks in my portfolio, which is far too conservative. Now, this dates back to an even older rule of thumb, which says you should hold your age in bonds. That's the equivalent of saying 100 minus your age should be your stock to bond portfolio ratio. This was a common adage in the more conservative age of portfolio planning, when the stock market crash of 1929 and the Great Depression were a less distant memory, and clients were more skeptical of the stock market. Plus, war and widespread smoking led to shorter lifespans. So that portfolio allocation may have been appropriate for a lot of people. But into the 1980s and 1990s, lifespans increased, and a famous financial planner came up with a different framework that was more appropriate for people at the time and going forward. A more academic and data-driven version of the minus your age rule of thumb emerged in a 1996 article in the Journal of Financial Planning by a famed advisor named William Bengen. I want to give a hat tip to a Rob Berger video on this topic because that's where I learned about this Bengen article. Now, Bengen is the same guy associated with the origins of the 4% rule of thumb in another paper he wrote in 1994. That led to the Trinity study that basically says you can safely withdraw approximately 4% of your retirement portfolio for 30 years without running out of money. So Bengen is a pioneer in financial planning and the financial independence movement. So in this paper, Asset Allocation for a Lifetime, he advocates that the constant in the formula ranges from 115 to 140. Bengen's paper and his math suggests that conservative investors should use the number 115 and minus their age. People with moderate risk tolerance should use the number 128, and aggressive investors should use the number 140 minus your age. Now, Bengen isn't just pulling these numbers out of a hat. He's a really serious math guy, and he's run the historical data and the math to come up with this framework in 1996. I actually think this is a better framework because you can determine your risk tolerance first and then use that as a starting point for the formula to get to your stock to bond ideal portfolio ratio. If I had used 140 from the beginning, my stock to bond ratio would end up where it is, right at 90% stocks to 10% bonds. But I'll still probably refer to this as the 130 rule of thumb because it's easier to round up from 128, and my readers are generally a bit more conservative than I am. So it's just a very easy rule of thumb to remember, 130 minus your age, and just leave it at that. And 130 isn't perfect. There's plenty of 40-year-olds that are not going to hold 10% bonds. They're going to be on 100% stocks. And then you've got 90-year-olds that may not be comfortable at 40% stocks and only 60% bonds. And that's why there's a lot of wiggle room, and that's why this is a personal finance rule of thumb and not a personal finance law. As I was researching this topic, I learned that Jack Bogle, legendary founder of Vanguard, advocated for the your age in bond rule of thumb. And he implemented that for himself into his 80s, but he also recommended the 120 rule of thumb over the years. So even Bogle gave it some wiggle room. One point Bogle certainly drove home during his lifetime was that age should influence your stock to bond ratio, increasing the percentage of bonds in your portfolio as you age. And that's a rule of thumb that most of us accept. Personal finance is littered with rules of thumb, but devoid of laws, right? And that's because everyone's experiences and personal situations and risk tolerance are different. They're personal. So navigating a rule of thumb like the minus your age rule of thumb requires taking in a lot of data points before making a decision. And of course, once the market opens, your portfolio ratio is going to change. So rebalancing your investment portfolio should be undertaken no more frequently than one time per year. That's all for this video. I'm Craig from retirebeforedad.com. I write about personal finance and investing for financial independence. Please subscribe to my YouTube channel if you like this video. Thanks for watching.